It's game over, Fed. You lose. I'm your host, Steve Van Metre, and thanks for joining me today. Investors are facing trillions of dollars in losses. Consumers are facing runaway inflation. In an effort to bring consumer prices down, the Fed is willing to destroy the American way of life. Let's head over to Wall Street Journal, where we picked today's story up with the headline, inflation sits at 8.2% as core prices hit 4-decade high. The Labor Department announced today that inflation fell to 8.2%, down a little bit from 8.3% in August, and that was down from the annual increase of 8.5% in July and 9.1% in June, which was the highest inflation rate in 4 decades. And perhaps as a sign that maybe inflation is peaking here, although consumers don't believe that, we can look at the Consumer Price Index and note that in periods where you see large run-ups, it's not unusual for it to stutter near a peak before it comes down. And there's perhaps an underlying catalyst that we'll take a look at here in a little bit that is telling us that inflation is going to come down, but at the sacrifice of the economy. Let's continue on. The so-called core CPI, which excludes volatile energy and food prices, gained a whopping 6.6% and spooked the markets in early trading. That from September from a year earlier, accelerating from 6.3% in August and marking the biggest increase since August 1982. And on a monthly basis, the core index rose 0.6% in September, the same as in August. Investors and policymakers follow core inflation closely as a reflection of broad underlying inflation and as a predictor of future inflation. And while the core doesn't always lead the headline CPI, it does a majority of the time. And the reason the markets got scared is this is telling us this is the last CPI print before the next Fed meeting. And what that means is the probabilities of a 75 basis point or perhaps even larger hike are on the table. The retreat of overall inflation from the June high came as gasoline prices cooled, but prices for housing, medical care, food, and other items have continued to increase, threatening to keep inflation higher for longer, which is a key point. Inflation has built up a lot of momentum over the last year, and that's going to keep inflation higher than the Federal Reserve wants for at least a couple more months, if not a couple more quarters. And there is a case we could see inflation stay elevated for a couple more months before it comes tumbling down. But let's take a look at the underlying data to see what's really going on with consumer prices. And here we have from the Bureau of Labor Statistics, the inflation report. And what do we note in the headline? A lot of the big push was from food. We see food at home, food away from home. Prices are rising, but notably energy prices, a key leading indicator here, are coming down. But how about this? Heading into the fall and cooler months, utility, gas service, pipe service, whopping 2.9% increase. But here's what's really driving the report and holding it up is shelter and transportation services and medical. But particularly we note that the shelter issue is a big one because as leases come due, what are landlords doing? They're raising their prices, and those rents are not going to decrease. So what we can note is that inflation is likely, in terms of prices, not likely to come down. But what we will expect to see going forward is the rate of change in those prices start to taper off in a big way. And here we can see the reason for that. It all comes back to energy, and energy is a leading indicator in the Consumer Price Index. And here we have the CPI overlaid with U.S. regular all formations gas price. And perhaps the reason we're seeing the headline number stay elevated here in blue is the fact that gas prices on a year-over-year rate change came up. They came back up to that top. They came up a third time, and then they came down. So what we're possibly seeing here is just a lagging effect, which we normally should see. You'll note that the red line does lead the blue line, that perhaps that the article is right of the Wall Street Journal that we will see the headline CPI stay elevated for a couple more months. But if gas prices are an indicator of future inflation, and they are, it tells us that inflation is going to come tumbling down. The New York Fed one-year inflation expectations also echoed that sentiment as consumers, their inflation expectations are now sliding to a 12-month low as household spending expectations crater the most on record. And here we can see the New York Fed inflation expectations. We have the 1-year number in red coming down, the 3-year coming back down right into trend, where the Fed will, of course, find themselves too tight as inflation eventually comes back down or even below their 2% target. And while we don't have the New York Fed inflation data in the St. Louis Federal Reserve database, surprisingly enough, we can look at and ask the question is, do inflation expectations matter? And to that, we turn to the University of Michigan inflation expectations in red, overlay that against the consumer price index in blue, and the answer is absolutely. We do see that expectations lead future prices. So while we may see the headline numbers stay elevated for a couple more months as rents and other factors that are lagging parts of the CPI get tacked onto there, the futures tell us that inflation is coming down at a time the Fed is ultra tight. What does that mean for the economy? Well, pretty bad news. Let's continue on. But while the continued decline in near-term inflation expectations will be welcomed by the Fed as longer-term expectations remain anchored not too far from their long-term average, a more ominous reading was seen in the expectations about household spending growth, which cratered to 6% from 7.8% in August, the largest one-month decline since the series inception of June of 2013. And that's a big point here, is that what the Fed is doing is destroying the American way of life. You see it, they're bringing the stock market down, they're driving interest rates up, and that will have a major factor on consumers and how they spend. Let's take a look at this chart here. You see household spending growth expectations coming down. We'll note that this is highly correlated to the U.S. stock market in terms of demand, and that's going to continue to head lower at a time when we look at record level of inventories and we see demand coming down. What it means is the economy is soon going to crater, and one thing that shouldn't crater with your economy is your portfolio. I'll put a link up here to Portfolio Shield and description below because the outlook from retailers is grim. Retailers are kicking off Black Friday in October, again, this time with too much stuff. Target said it would roll out both daily and weekly deals now through the week of Black Friday, while Walmart said Monday was offering 4 days of discounts this week for early holiday shoppers. And not to be outdone, Amazon shoppers favor household goods over big ticket items in second Prime Day, at a sign perhaps of desperation from the big retailer. The average order size as of 1 p.m. on New York on Wednesday was $46.44. Get this, down 23% from the Prime Day sale in July, according to Numerator, which based its most recent data on just under 20,000 orders. Again, a sign of desperation from Amazon. 2 Prime Days in 1 year, too much inventory to clear. This is the same time Amazon has held 2 Prime Focus sales in the same year, suggesting that the company was looking to give customers a reason to splurge during what many analysts expect to be a lackluster holiday shopping season. Now, the reason you're seeing all of these early sales is because retailers are starting to figure out that people have less and less money and they've got a lot of stuff. They want to get that money before it's too late, setting us up for a really bad holiday season and massive discounting going into early next year, as they're going to be forced to slash prices, perhaps destroy goods, and do anything to get this inventory out. And we're seeing this now in the import data show up that says that they realize they've got too much inventory, they're cutting orders, and we're seeing imports start to crash. U.S. imports sink in September, suffer the steepest drop since 2020 lockdowns. First came the pullback in spot shipping rates from their historic peak. Then came reports of plunging Asian bookings and mass, get this, retail order cancellations. Only happens when you have too much inventory and not a lot of demand. With spot rates falling even faster, now all this is finally showing up at America's ports. And according to SCARDIS, which aggregates U.S. customs data, inbound volumes to all U.S. ports was down in September 11% year on year and 12.4% in August. And this, of course, is not good news, because what did we see from all of those ports and the unions that are running those ports is they demand big wage increases. Of course, that's happening throughout the country, and all of a sudden demand starts to fall, and that will ultimately lead to more unemployment claims. But a further sign demand is starting to tumble, well, we got the U.S. crude oil inventory data today, and it wasn't pretty. We see crude oil inventories rose almost 10 million barrels, gasoline inventories up 2 million barrels, and only distilled stocks, namely which would be jet fuel, was down just under 5 million barrels. And again, a sign the global economy and U.S. economy are slowing as demand for energy decreases, and that ultimately leads to lower consumer prices. But will that give the Fed cause to pause? Well, probably not. Two Fed officials make the case for caution with future interest rate raises. As we note that Fed Vice Chairwoman Lael Brainerd noted how previous rate increases, together with anticipated further rate increases, will slow the economy in ways that can't be observed yet during a speech on Monday. Ms. Brainerd said the Fed was likely to continue raising rates and maintaining them at a higher level to ensure inflation comes back to the Fed's 2% target. But her speech was laced with reasons to expect inflation to soon diminish, which she is arguably going to be right about, which could in turn stay the need for the Fed to raise rates beyond levels already anticipated by investors. It will take time for the cumulative effects of tighter monetary policy to work through the economy and to bring inflation down, she said. The moderation in demand due to monetary policy tightening is only partially realized so far. But what we're seeing is the November rate hike is now pretty much baked in the cake. December, who knows? We'll see if we have another CPI report after the Fed meets before the December meeting. But what we're facing at this point is the Fed's willingness to destroy the American way of life to bring inflation down. What do you think about that? I'll let you weigh in the comments. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.